everyone, Abdel Misa here. Thank you for joining me. So the Fed has printed trillions of dollars recently to respond to the coronavirus crisis. Its balance sheet has expanded to almost $7 trillion, 8 times more than prior to the financial crisis. So, oh my gosh, hyperinflation, here it comes. We are doomed. We are screwed. But is it that simple? So as a money manager, this is a really important question, whether we're going to deal with inflation going forward. This is a serious business, because if that's the case, I need to change my investment strategy and adapt to a new investment environment, and then use products that hedge against inflation. And so is the case for you. Like, as I said, this is serious. This is not about reporting news or just letting you information. This is something that's really, really important, because if we're dealing with a hyperinflation going forward, for example, the worst that you can be is to be in cash and just have your money sitting at the bank earning nothing. Then it will be a catastrophe. But before we get started, can you please help me like hyperinflate that like button and subscribe to the channel? And so let's get going to figure this out. So here goes the logic. If the Fed prints 8 times more money, going from around 800 billion to almost $7 trillion, there is 8 times more money in the system, and therefore prices should go up by 8 times. Therefore you get a huge inflation. Except this logic is totally flawed for 2 reasons. One, it assumes that demand is the same. Okay, so we are in a recession. Demand is absolutely not the same. Demand goes down, so you can't assume that demand is the same. The second flaw, it assumes that the amount of money available in the economy is what the Fed prints, and that does not take into account credit and how money multiplies through the economy. So let's go over these 2 very fundamental concepts and then break them down. So let's look at the first argument, that money printing causes automatically inflation or hyperinflation. Okay, so let's take an analogy. What if like somebody jumps from 15 feet, and then automatically we're gonna assume that jumping from 15 feet is going to break the leg? Okay, well, no, not necessarily, right? Because it depends what they jump on. If they jump on concrete, sure, okay, they'll probably break their leg. But what if they jump on a trampoline? Then they're not gonna most likely break their leg. Well, it's the same thing here applies for money printing versus inflation. Because what if with money printing, we are printing money where the demand is low? Like in this case, when there is a recession, well, guess what? Most likely you're not gonna have inflation. Now, if you are printing money and you have a lot of demand and things are good, then of course you're gonna have inflation. So in this case, printing money with demand, it's like jumping from 15 feet and then jumping on concrete. So you need another condition to have inflation, which is not only money printing, but you need to have high demand. Another flaw with the logic that money printing automatically generates hyperinflation is that it ignores a key concept on how money multiplies through the economy through credit. This is a really, really important concept to understand. And so here is how it works, okay? So you put $100 with your bank. So then the bank has a reserve requirement. For the sake of this example, let's put it 10%. So the bank goes and then puts 10% with the Fed. Okay, so that's $10. And then the other $90, the bank can then go and lend it to somebody else. So let's say your friend goes and then borrows $90. So now the amount of money in the system, you still have your $100. So overall, there is $190 in the system. The money has multiplied, but it does not stop there. So the bank again has $90, right, deposited by your friend, and then it takes 10%, it's $9, and then it keeps the $81 that it can lend again, okay? So this money multiplier concept is really important to understand. And so the argument that, look, while the Fed has tripled or quadrupled the money, that means like we're gonna have 3 times or 4 times prices are gonna go up, does not make any sense, because it ignores how much money is really in the system, okay? So just the fact that the Fed has the balance sheet of the Fed is $6.7 trillion does not mean that that's the entire money in the system. It's way more, and it multiplies through credit. Now, when we are in a recession, guess what happens? People borrow less, all right? So because people borrow less, there is actually less money that's multiplied. And the fact that the Fed then prints money to counteract that does not mean that we are going to get inflation. So this money multiplier effect is really important to understand the impact of money printing on inflation. And I think you understand it now. And then so what I'm asking is, can you use it for my likes? Can you multiply my likes and then click on those like buttons to show me this multiplier effect? So everybody is of course worried that we are going to be dealing with a hyperinflation scenario just like Zimbabwe or like Germany in the past century. But let's look at real examples where that was not the case. So after the financial crisis, the Fed actually went through 3 rounds of quantitative easing, 3 rounds of money printing. Its balance sheet expanded 5 times, from almost around 800 billion to almost 4.5 trillion dollars. Now, did we have inflation? Absolutely not. In terms of inflation, in fact, the Fed target price is 2%. The Fed has consistently missed that 2% target for a long time. So we haven't seen inflation. In fact, we have missed, and certainly we haven't seen the hyperinflation that everybody was worried about back then. Yeah, so in 2010, I was in New York and I attended a lunch by a hedge fund manager, billionaire John Paulson, and he was making the argument that, look, because the Fed is printing so much money, then we're going to have hyperinflation, and therefore it was worth like buying gold over the long term. And I just said, like, look, like we didn't have any inflation, and the argument was flawed. Just saying that, look, because there is money printing, we're gonna have inflation does not make any sense. You have to take into account way more variables to make that decision. I see the same argument being made right now by Paul Tudor Jones, another legend in investing and a billionaire hedge fund manager, and then he's making the case that basically with all this money printing of central banks around the world that we're going to deal with inflation. And then in fact he has invested recently in Bitcoin futures to hedge against inflation. And again, he might have other reasons, but just saying that, look, because the balance sheet and then we have money printing leads to inflation, that argument is flawed. You need way more to make that argument. Another example where we might have expected hyperinflation due to money printing is Japan. And Japan has been dealing with deflation for the past 3 decades, and they have printed so much money, but where is inflation, right? So just printing money does not mean you're gonna get inflation. And in fact, let me bring up this very important point. In the Great Depression, one of the major mistakes that the central bank has made back then is actually they tightened monetary policy instead of loosening monetary policy. During the Depression, we should have been printing money to loosen the policy and then be able to stimulate the economy. And that's why we had to deal actually with the Great Depression, because the economy got worse. While like if we had stimulated the economy through monetary policy, things probably would have been better faster. So let me give you my own personal opinion about this whole debate, whether this money printing causes automatically inflation. To me, it's nonsense. The Fed is getting too much bad press, especially from people that don't even necessarily understand how the economy and how the markets work. Let me give you an analogy. It's like if you're having a dying patient and then you have a potential treatment to save their lives, but the treatment can potentially have some side effects later. What do? So just put yourself in the shoes of the Fed. What would you do here? We are dealing with a massive crisis, so if you are in the shoes of Jerome Powell, what would you do? Would you just stop and do nothing because you say, look, like I might have inflation later, and then you don't stimulate the economy? That's exactly what we did in the financial depression. But then when they take really actions and then do the right things to help stimulate the economy, then we blame them and be like, hey, you are going to generate inflation later on. That's too easy and it's not fair to the Fed. This is especially true when, in fact, the Fed has created tools to suck money out of the system when it needs to do that. So, for example, they have been very successful after the 3 rounds of QE, reducing the balance sheet. And one of the key tools that they have is they can guarantee short-term interest over the short term, and basically overnight they can take the money, as much money as they need, and then take it out of the system. So they don't necessarily have to sell long-term bonds or let bonds expire. They created very intelligent and smart tools to be able to take out the money in a very intelligent way. So I personally do not buy the argument of, all right, money printing, inflation and all of that. Now, if the argument is that we are creating asset inflation, maybe. Are we propping stock prices because of low interest rates and low discount rates? Yes, for sure. Are we creating potentially more income inequality? Yes, that is the case. But again, you don't have a lot of choices. What do? It's not like black and white, okay? The solution is somewhere in the middle. You have to figure out what is the best. And if you and I probably were in the shoes of Jerome Powell, we will be probably doing exactly the same thing. Recently, Warren Buffett commented on Jerome Powell, the Fed chairman, and then he put him at the same level as Paul Volcker, who is a legend in the Fed because he was successful in fighting inflation in the late 70s and 80s, and then he raised interest rates so much, and people were against him because he generated a recession, but he ultimately was right. And Buffett put Jerome Powell at the same level as Paul Volcker due to his recent actions, and I couldn't agree with him more. I think Powell is an excellent Fed chairman. And by the way, I mean, just look at him. He's really a nice guy. It seems like you can hang out with him. So come on, give the man a break. He's doing a fantastic job, and we should be proud and to have a Fed chairman such as him at the helm during this crisis. I hope today's session was helpful. Again, like, this is the real deal. This is very serious. This is not about just figuring out inflation or no, or me like news reporting, which that's not what I'm here for. I'm here to make you learn how to invest like a professional. This is a real decision making that we have to deal with, because for me, I have to make decisions about the portfolio and figure out what do I need to do for my clients. And so it's a very, very serious business, and I urge you to take it seriously, because this is definitely a key question going forward, whether we are going to be dealing with inflation or not. So with that, I appreciate your time today. Please make sure to subscribe, like, and then press that notification button. Thank you so much for your support, and I will see you next time.